Professor Rao, Professor Mahendra Dev, Professor Sarkar, Mr. Pandit, distinguished invitees, and graduating students. It gives me indeed very great pleasure to be in your midst this morning and to address the 9th convocation of IBADR. I was closely associated with the setting up of this institute, and I therefore naturally take pride in knowing that the institute has now emerged as an outstanding institution of research and teaching in economics. Convocations are occasions of joy, time to feel a sense of achievement, but also a time for reflection and contemplation of what lies in the future. I'm sure all of you assembled here today feel that way. To all the graduating students, let me first extend my heartiest congratulations and wish them all success in their professional lives. I propose to speak to you briefly on some issues of central banking. Central banks have been evolving over time. They respond to changing times and changing economic philosophies. For example, the money neutrality proposition has undergone many changes. 19th century central banks were different in many ways from the 20th century central banks, and so will the 21st century central banks. Monetary policy has had its ups and downs in the post-Second World War period. In industrially advanced countries, after decades of eclipse, monetary policy re-emerged as a potent instrument of economic policy in the fight against inflation in the 1980s. The relative importance of growth and price stability as the objectives of monetary policy, as well as appropriate intermediate targets of monetary policy, became the focus of attention. The recent churning of the financial system has raised several new questions, not only with respect to the objectives of monetary policy, but also to the overall conduct of central banks. I had, on an earlier occasion at this institute, spoken at some length on the objectives of monetary policy. I do not want to go over the ground again, but I do wish to highlight a few important issues that have risen. The issue of objectives has become important because of the need to provide a clear guidance to monetary policy makers. With the increasing emphasis on the autonomy of central banks, this has become all the more important. Autonomy goes with accountability, and accountability in turn requires a clear enunciation of the goals. While the various enactments setting up the central banks specify the objectives, they are usually framed in such broad terms that they are not very helpful in providing a clear guidance to the central banks. For example, the Reserve Bank of India Act requires the Reserve Bank of India to conduct the operations, and I quote, with a view to securing monetary stability in India and generally to operate the currency and credit system of the country to its advantage. Central banks have, however, over time, tried to specify in clearer terms the objectives they seek to pursue. While talking of the objectives of monetary policy in India, I had said on an earlier occasion, and I quote, in a broad sense, the broad objectives of monetary policy can be no different from the overall objectives of economic policy. The broad objectives of monetary policy in India have been, one, to maintain reasonable degree of price stability, and two, to help accelerate the rate of economic growth. The emphasis between the two objectives have changed from year to year, depending upon the conditions prevailing in that year and in the previous years. The choice of a dominant objective arises essentially because of the multiplicity of objectives and the inherent conflict among such objectives. Faced with multiple objectives that are equally important and desirable, there is always a problem of assigning to each instrument the most appropriate objective. This assignment rule favors monetary policy as the most appropriate instrument to achieve the objective of price stability. One way of reconciling the conflicting objectives of price stability and economic growth in the short run is through estimating the threshold level of inflation, the level beyond which the costs of inflation begin to rise steeply. It is this inflation threshold which will provide some guidance to policymakers. Below the threshold level of inflation, there is a greater scope for the policymakers to take into account other considerations. Once the threshold level of inflation is crossed, the primary concern of the central bank will be to control inflation. The Chakravarti Committee regarded the acceptable rise in prices as 4%. The concept of threshold inflation gives to monetary authorities greater maneuverability than the more rigid inflation targeting. However, the primacy of price stability as an objective of monetary policy, particularly in developing countries, must be recognized. Our own experience in the last 2 years is a clear reminder of this. In the wake of the international financial crisis of 2008, financial stability has also emerged as a serious concern of central banks. Prior to the current crisis, the link between financial stability and monetary policy was not clearly understood or perceived. Most central banks treated financial stability as an extension of the regulatory responsibilities, even as monetary policy primarily focused on inflation control. It was also believed that price stability was generally favorable to the development of financial products and markets. In effect, price stability and financial stability were pursued through two separate tools. Tinbergen's separation principle, that is, that each goal should be pursued with separate and dedicated instruments, was widely accepted. There is a raging debate as to whether the recent financial crisis in the West was precipitated by monetary policy failure or regulatory failure. It has been argued that lax monetary policy led to low interest rates, which caused many distortions in the system, culminating in the crisis. The macro conditions preceding the crisis, which included low real interest rates, are due to the great moderation with a long period of very stable growth and stable low inflation. This led to systematic underestimation of risk and very low risk premium in financial markets. Those who argue that the crisis was triggered by regulatory failure point to lax regulation and supervision, which led to increased leverage, regulatory arbitrage, and less due diligence on loan origination. Those who argue that monetary policy was not responsible for the crisis only concede that a low interest rate regime could have at best facilitated an environment of high risk taking. They also doubt whether a different monetary policy could have prevented the crisis. The key issue, however, is the role of monetary authorities in the context of rising asset prices. Should they intervene, and if so, in what manner? The policy of cleanup after the burst, rather than taking preventive actions, was a choice that cost the economies bitterly. When the bubble explodes, it becomes a responsibility of the central banks to restore confidence in the market. There is no doubt that asset prices should be considered as important inputs in monetary policy formulation. Obviously, price stability alone is not enough to achieve financial stability. Also equally, interest rate policy by itself is not enough to achieve financial stability. It is fortunate that in the post-crisis period, sharp reductions in interest rates were facilitated by declining inflation. It was a comfortable coincidence. A rising inflation in that context would have made the task more difficult. Even as monetary policy encompasses financial stability as part of its mandate, the major responsibility with respect to financial stability still rests with regulation and supervision. It is ironic that a serious regulatory failure should have happened at a time when serious and extensive discussions were being held at Basel and elsewhere to put in place a strong regulatory framework. Many central banks, in fact, were preparing financial stability reports even as the Financial Stability Forum was set up. There were many shortcomings in the financial system of the industrially advanced countries. The soft touch approach left many segments of the financial markets go without adequate supervision. The distorted incentives for commercial and investment banks to increase the leverage had to be plugged. The recent crisis in the US and other countries is a reflection of both monetary policy and regulatory failure. While regulatory failure bore the primary responsibility, monetary policy played a facilitating role. We need to draw appropriate lessons from the crisis. Monetary policy as an instrument of policy has a chief merit of responding to changing events. While it can have multiple objectives, it needs to steer in a clear direction, and prioritization of objectives becomes essential. It has to create a hierarchy of objectives. The mandate of the central bank has become wider. This is inevitable with the increasing complexity of the system in which central banks operate. Total discretion with respect to objectives and instruments will make monetary policy indeterminate. Central banks need to be transparent and explicit with respect to objectives. Let me move on to another item, capital flows and central banks. Capital flows in general are welcome. They add to the productive capacity of the country. They also lead to the development of financial markets. However, the problem with capital flows is their size and volatility. When the capital flows are large, with a high degree of fluctuation, they have a bearing on macroeconomic stability. The position with respect to capital flows, as far as emerging economies like India are concerned, has changed dramatically over the last 2 decades. Prior to 1991, our major concern was to mobilize enough capital flows to finance a current account deficit. But that position has changed. Thanks to the development of the international capital markets, today the emerging economies, including India, are able to attract large capital flows. 2007-8 was an unusual year when there was a heavy influx of capital flows into India, and the central bank added almost $100 billion to its reserves. When the inflows are large, there are 3 options open to the policymakers. The first option is to let the capital flows pass through the foreign exchange market fully. This will have the effect of making domestic currency appreciate, with possible adverse consequences on the country's exports. This will be particularly uncomfortable if the country was experiencing already a current account deficit. The second option is to absorb the inflows into reserves. If unsterilized, these inflows will lead to expansion of money supply, causing prices to rise. Domestic inflation has its own implications. Apart from this, when prices are rising, the real effective exchange rate will rise even when nominal exchange rate remains unchanged. If sterilized, some of the consequences of reserve accumulation can be moderated, but this will imply a cost which will depend on the return on foreign exchange resources and the cost of borrowing. One has to balance the self-insurance benefit of reserves with the cost. The third option is to use capital controls to restrict the inflows and to stimulate the outflows. Capital controls are not that easy to monitor. However, as a temporary measure, restrictions on some forms of capital flows have been adopted by several countries. In fact, the response to large capital inflows is always in the form of a mixture of the three options. The policymakers may let the domestic currency appreciate to some extent, absorb some part of the reserve or the flows into the reserves, and impose some control on capital inflows. India's response to the capital flows in the last decade has involved a mixture of these three options. While capital controls have gained some respectability in the context of the recent financial crisis, they are always seen as temporary measures. In fact, the best policy option in these circumstances is strong economic growth, which can absorb the large inflows without affecting stability. India's policy towards capital flows underwent a far-reaching change after the liberalization measures were introduced in 1991. Prior to that, the major source of capital flows was external assistance. The total inflows on the capital account have expanded once again dramatically. They stood at $7.1 million in 1990-91. They have started expanding rapidly to reach $45 billion in 2006-07 and also reached the peak of $107 billion in 2007-08. During 2010-11, they amounted to $60 billion. Until the end of 2010-11, the capital flows have been adequate to cover the current account deficit and add some to the reserves. In the recent period, the only year in which the capital inflows were inadequate to cover the current account deficit was 2008-09, when the foreign exchange reserves declined by $20 billion. In the current year, we see a mismatch between current account deficit and the capital inflow, particularly in the quarter ending December 2011. This has put pressure on the rupee to depreciate. However, with the resumption of capital flows in the first quarter of the current year, 2012, the pressures will begin to ease. The current account deficit has remained at around 2.5% of the GDP in the last few years. In the current year, it may be even higher. Against this background, we must take all measures to encourage capital flows. However, given the inherent volatility of capital flows, our objective over the next decade must be to reduce the current account deficit to a much lower level. In the Indian context, capital flows have remained by and large stable. An analysis has been done of the FII inflows in the wake of the Lehman crisis of September 2008. During the month of October 2008, gross equity sales were of the order of 68,000 crores. However, some FIIs still felt that the outlook for investment in India was good. In that very month, FII the purchases amounted to 52,000 crores. Putting these together, the exit by foreigners from the Indian equity market in this once-in-a-century crisis was 16,000 crores. Adding up across October, November and December 2008, the overall net sales by the foreigners amounted to 6% of their holdings at the end of September 2008. Thus, even in the worst scenario, the outflows have been modest. Even in 2011, the total FII investments in debt and equity taken together have remained positive at $8.3 billion. However, this is much lower than what came in the previous year. It may be recalled that in the East Asian crisis, the most volatile capital flows, as far as the affected countries were concerned, was banking capital. Thus, we need to encourage capital flows. At the same time, we must work towards achieving a lower level of current account deficit. And we must remember that even in 1991 or 91-92, when we had a severe balance of payments problem, the current account deficit was only 3.1% of the GDP. The problem is essentially how to finance that deficit. To attract and retain capital flows, domestic economic policies must be deemed to be appropriate by external investors. To this extent, domestic policies are subject to external oversight. However, capital flows have their own dynamics. They flow towards countries which grow fast in an environment of low inflation and modest fiscal deficit. In many ways, these are also our domestic goals. Moving to the exchange rate regime underwent a fundamental change in the post-liberalization period. Prior to 1992, the exchange rate of the rupee was determined on a daily basis by the Reserve Bank, with the central bank willing to buy and sell at the fixed rate. This system could work only in a regime of stringent import controls. However, in the late 1980s, the nominal exchange rate was adjusted by the Reserve Bank to ensure that the real effective exchange rate did not appreciate. This was, in essence, an attempt to mimic the market. In 1992, the country moved to a dual exchange rate mechanism. In the early 1993, it moved to a more or less market-determined exchange rate regime. And I do think that this shift in the early 1993 to the market-determined exchange rate system is one of the most important measures undertaken in the post-liberalization period. While the exchange rate is by and large determined by the market forces, the Reserve Bank does intervene in the market from time to time. The stated objective of intervention is to prevent undue volatility in the exchange rate. However, in the years when capital flows were very large, and more particularly in 2007-8, the Reserve Bank intervened to prevent the excessive appreciation of the rupee. As remarked earlier, in the context of the capital flows, a mixed approach was adopted by the Reserve Bank to deal with the problem of excessive capital flows. A critical question that is being asked is, what should be the appropriate exchange rate policy for a country like India? In the normal circumstances, the appropriate stance of policy should be to let the market forces determine the exchange rate. The extent of the current account deficit, in conjunction with the capital flows, will determine the level of exchange rate. This may not, nevertheless, rule out the possibility of intervention by the central bank to smooth temporary fluctuations. However, extraordinary circumstances may warrant a different kind of response. When the country is running a current account deficit, the authorities may not want the domestic currency to appreciate in real terms. Under those circumstances, when there are large capital inflows, the monetary authorities can intervene and absorb some part of the capital flows into the reserves to prevent appreciation. However, it is important to note that the current account deficit cannot be corrected purely through exchange rate manipulations alone. If you look at the performance of exports in recent years, it will be seen that India's exports boomed very strongly, even in those years when the exchange rate had a tendency to appreciate. Even in the current year, the growth rate of exports in the first half of the year was extraordinarily high at 50%. With the import content of exports increasing, one cannot draw a very simple conclusion on the impact of exchange rate on exports. A host of other factors is responsible for the performance of exports. Depreciation of exchange rate has also an adverse impact on capital flows. Thus, the exchange rate policy should normally be to let the market forces determine the exchange rate. However, in times of unusually large capital inflows, or for that matter outflows, the central bank can intervene to prevent undue appreciation or depreciation. It is for this reason that the exchange rate regime prevalent in India is still classified by analysts as managed float. Finally, let me conclude by making a few remarks on regulation and innovation. The development of the financial system is considered crucial to sustaining high economic growth. However, in the wake of the current international financial crisis, some questions have been raised whether the unfettered development of the financial market and products is good for the economy. It has been argued that not all financial innovations are welfare maximizing. Banking development has taken big strides in the last few decades. The basic motivation for innovation of new financial products is to improve customer satisfaction. The question that is being increasingly asked is, whether the financial sector today is inherently more volatile and vulnerable than before. The very factors that may have contributed to the growth of the financial sector may well have contributed to increased fragility. Close interdependence among markets and market participants have increased the potential for adverse events to spread quickly. They have increased significantly the scope for and spread of contagion. Some question whether the new financial products serve any socially useful purpose. It has been argued that much of the recent innovations in the financial system has sought to increase the short-term profitability of the financial sector rather than to increase the ability of the financial markets to better perform their essential functions or managing risks and allocating capital. In addition, it has been pointed out that some of the innovations have engendered financial instability. In my view, it would be inappropriate to classify all or even most of the financial innovations introduced in the last few decades as socially purposeless. Many of the financial products satisfy a felt need. We are living in a world of uncertainty. Customers need to protect themselves from the volatility in exchange rate and interest rates. Appropriate hedging mechanisms are therefore needed. It is a function of an efficiently organized financial system to provide these instruments. It is wrong, therefore, to argue that economic growth seen by the industrially advanced countries in the recent period, particularly in the last decade and a half, has not been helped by the improvements in the financial markets. But excesses in any field have their own dangers. There is no argument that the regulatory regime in these countries particularly needs to be restructured to make the banking system more sound. Excessive risk-taking and leveraging by banks need to be discouraged by appropriate regulatory measures. But to set the face against financial innovations is not a wise policy. In developing economies like India, the structure of the economy is undergoing a rapid change. The financial system must be able to meet the diversified needs of a growing economy. In this context, we must actually encourage financial innovations. For example, in the Indian context, I would like to cite two instances. First, there is a need to encourage the emergence of a vibrant corporate debt market. Efficient debt market will help not only large borrowers, but also small and medium enterprises. A number of suggestions have been made to create an efficient debt market in our country. Apart from other things, this will also need institutions which will serve as market makers offering two-way course. This will provide the required liquidity to the market and make it attractive to the investors. Second, there is a need to explore innovative ways of financing infrastructure. Banks at present have certain limitations. They have to take care of the mismatch in the liability asset management. Of course, a vibrant debt market will also help investors' need for long-term funding. Takeout financing has been suggested as one way by which the tenure of loans can be increased. Thus, the scope of financial innovation continues to remain wide in India. We need to draw, once again, appropriate lessons for the current international financial crisis. Too little regulation may encourage financial instability, but too much of it can impede financial innovations which are badly needed. Regulatory oversight of innovation is necessary, but the regulatory perspective on innovation must not become too restrictive. We must also note that we should not cross the thin line dividing regulation from control. Thank you very much and wish you all the best.